In a bid to boost liquidity, the government has decided to pump in 41,000 crore rupees more into public sector banks in the form of capital. This move is part of supplementary demand for grants tabled in Parliament. So which are the banks that are likely to get this extra, this incremental capital? The Finance Minister laid out 4 broad categories of banks who will benefit. First, banks that need the capital to meet the minimum capital regulatory norms. Secondly, government believes 4 or 5 PSU banks that are in the prompt corrective action straitjacket of the Reserve Bank could, with this capital infusion, come out of the PCA norms. Remember, the PCA norms were imposed on banks with large net non-performing assets. It also imposes some lending curbs on these banks. Third, the government also expects 3 public sector banks that could fall into PCA if they don't have enough capital. And so to keep them afloat, this fresh infusion is being planned for these banks. Punjab National Bank would be one such bank. And finally, the capital will go into banks that are getting amalgamated this year. So Dena Vijaya are getting amalgamated into Bank of Baroda. That combined entity is likely to receive some of the money. Let's hear it from the big man himself, the Finance Minister.
Will now have 42,000 plus 41,000, which is 83,000 for the balance year. And that will make this year's recap to a total of 1,06,000 crores. The first, of course, is to ensure that the banks meet their regulatory capital norms. The second will be that the better performing PCA banks are given capital to achieve a 9% capital to risk weighted asset ratio, the CRAR, so that some of them are able to come out of the PCA itself.
Okay, to discuss whether most of the capital needs have been satisfied, we have with us an eminent group of experts. Anil Gupta from ICRA, he's the banking analyst from ICRA. Former Executive Director at Bank of Baroda, Mr. R.K. Bakshi. Jindal Haria, Associate Director, India Ratings. And Sameer Naran, the Chief Economist at Bank of Baroda. In a minute, we'll also be joined by Mr. V.G. Kannan, the CEO of the Indian Banks Association. Gentlemen, thank you very much for joining us. Anil Gupta, let me start with you. What were your expectations? It looks like with this additional 41,000 crore, the original number of 2.1 lakh crore has been bettered. I think now something like 2.25 lakh crore is getting infused. You think this is enough?
Yeah, I think as per our initial estimates also, 2.11 lakh crores was sufficient enough, provided the banks would have been able to raise the capital from the markets. But the 2.11 lakh crores included 58,000 crores from market raisings, which if you look at no bank after the fraud which was detected at PNB, none of the bank has been able to raise the capital from the market.
Anil, sorry, that is 24,000 crores. The minister gave that number. Of the 58,000 crore, 24,000 crore has been raised.
Right. So with this 41,000 crores, this will plug the gap. And to a large extent, I think this should be sufficient for the banks to meet their regulatory capital ratios as well as providing growth capital to some banks.
Okay. Let me come to Jindal on the distribution. The distribution appears to be one set which is doing well, but is only falling short on capital in the PCA list. So that perhaps would be Bank of India, Oriental Bank of Commerce, maybe Corporation Bank. The other set that will get are those that may get into PCA, so probably Punjab National Bank. And the third set are those that are amalgamating, like Bank of Baroda. What is your sense, Jindal? Is this a fair distribution of the capital?
Yeah, I think that seems fair. Take the example of the eastern part of the country. There are 3 public sector banks which play a dominant role there. United Bank, UCO Bank and Allahabad Bank. And all 3 banks have would have difficulties in trying to meet their minimum capital requirements. So I think you cannot have 3 banks in a region, all of them handicapped on the lending front. So the region of course needs continuous credit to grow SME, agri, small industries. So I think that's a fair distribution on that part, that some of the PCA banks, the capital infusion focuses on a particular set of PCA banks to get them out if that's the case. The second is, of course, to meet the minimum capital requirements. I think that's not an option for most public sector banks. So at least that basic minimum level of capital would need to be established at the with all the public sector banks. And with regard to the amalgamated entity, which is Bob, Vijaya and Dena, our assessment suggests that they may not necessarily need additional capital to meet the minimum capital requirements, but just in case harmonization of NPA recognition across the three banks, if at all that number surprises on the upside, then some capital may be required for the amalgamated entity to grow.
Okay, so that seems like a fair set. Let me ask Mr. Bakshi now, the man who knows where the shoe will pinch or would have pinched. Mr. Bakshi, the restriction on most of the prompt corrective action bank list was that they cannot lend to companies below A rating. Now, this restriction will go away for at least 3 or 4 banks like Bank of India, maybe Corporation Bank and Oriental Bank of Commerce as well. Will that make a big difference?
So, I think capital adequacy is a hygiene factor. It has to be there, otherwise you are under PCA and you are not allowed to lend. But after that is the demand from acceptable borrowers and the bank's inclination to lend in the light of their past experiences with certain sectors, certain borrowers, new projects coming up, whether the environment enabling them to grow into profitable ventures has been created. Where it will definitely facilitate is the PCA banks have a number of good BBB plus type of borrowers who need incremental funding either on the working capital or on the loan side, which they are not able to support right now. So I think that will be the niche that will get catered first by these banks, and that should definitely facilitate because for those borrowers, suppose they are a single bank relationship, for them to scout for another bank because their original bank under being PCA is not able to lend to them, that will facilitate. So definitely it will ensure flow of credit to some of the needy sector.
Okay, well, let me persist with one more question before I go to The Economist. The bankers have been put through a lot. I'm not trying to say that the entire banking community would have been dishonest or honest, but they have been taken to the CBI more than, say, politicians have been taken, or more than perhaps even businessmen have been taken in the last 24 months. Do you think now there will be, that kind of risk appetite among bankers, Mr. Bakshi, despite the fact that they have been given a lot of liquidity and now also capital?
So, environment definitely creates either an incentive or a disincentive for the officers or executives to take decisions or to delay decisions. So, some of the things which you are mentioning may definitely dent optimism or dent enthusiasm at times, because nobody who takes an honest decision wants to be put through avoidable scrutiny now or later in their retirement years. But the other thing also is that despite that the banking sector has not totally stopped lending, it has not, some banks were under PCA, new projects were also not coming up. I think the 15% credit growth might be resulting from a lot of retail, SME, some NBFC portfolio and maybe government sector lending, and maybe utilization of unutilized working capital limits, which are always there in the banking system. So banks will lend, but definitely if a better environment can be created where people can be cushioned, of course PCA Act amendment is a definite boost in that direction.
Oh yes, that's the big difference now. Prevention of Corruption Act has been amended to ensure that not all loss of public funds is visited on the banker. Let me come to Samir now. Samir, what is the sense you're getting? if we are going to have 3 or 4 banks out of the prompt corrective action, if likes of Punjab National Bank are kept away from PCA and a little growth capital is provided to the likes of Bank of Baroda, are we going to see a much better rate of growth of bank loans?
Actually, the situation has turned around quite a bit in the last few months because of the NBFC liquidity crisis. So NBFCs were actually growing at 20% odd, and the resources are not available to them. So the banks have to do the heavy lifting, and bank rate to NBFCs actually grew by almost 50% in the month of October, for which the data is available. So yes, given the macro backdrop, it was required that banks do the heavy lifting, and for which capital is being provided. A number of banks led by SBI, Bank of Baroda and now PNB will be in a position to lend if additional growth capital is available. So additional 40,000 crore with the capital adequacy ratio of say 9 or 10% gives you 4 lakh crore kind of a number, which is 5% of aggregate credit. So that should take care of any liquidity infusion for the NBFCs also, because NBFC's balance sheet itself is more than 20 lakh crore right now, excluding HFCs. HFCs are another 11 to 12 lakh crore. So that's a 30 lakh crore balance sheet, and out of which say 7 to 8 lakh crore is with the debentures and CP market, which is kind of iffy right now. So it should take care of the temporary liquidity squeeze which will happen for NBFCs in February and March, when a lot of repayments are due.
Actually, you've defined the problem very well. So it's about 7 to 8 lakh crore, which is kind of immobilized or finding it difficult to be renewed. Can this entirely be provided by the public, by the banks and more, Samir? Is it a perfect replacement?
No, it's not actually, because banks also have their own caps, to a sectoral caps, which are internal, but they have regulatory caps in terms of to a single entity exposure, or the group entity exposure has been defined. But however, at the same time, they can do portfolio buyouts and all of that. Unless they have that kind of capital available, there would be no products available in the market to be bought over. So given the one situation is that if there is ample of liquidity available in the market, there are other set of buyers who will be interested in the portfolio, because they look, if I don't buy it, somebody else will. So I think it gets the market moving, it improves sentiment. So it's overall good for the economy and for the system as we move ahead.
Okay, not a perfect replacement. Let me get the other big man from the banking sector. He's now joined as VG Kannan, CEO of Indian Banks Association. Thank you very much, Mr. Kannan. It's the total amount of capital, which was originally planned at 2.11 lakh crore, I think is now likely to end more like 2.3 lakh crore, because there is an additional 41,000 crore announced. What's your sense? You think this is good enough, good to go for a year?
See, earlier in the year itself, the bankers were requesting that if at all any capital infusion is there, it should be done at the earliest. Because the earlier the money comes, then the banks can operate from a position of strength and start either lending or even making other plans, including raising funds from the market. Okay. And I wouldn't say this is very early, but hopefully much better than coming in the last day of the financial year. So that way this is helpful. The fact is the treasury yields have also come down. So to that extent, the additional capital requirement, which is also meant to ensure that the treasury losses are taken care of, that is also is minimized. And I'm not, I don't have the exact figures, but I think this is a good step forward. They have already identified some of the banks where they will need to infuse the funds, and especially the banks which are tottering around the PCA norms. And that will certainly help them to raise funds from the market, or including by going aggressively for other areas of raising from non-core assets. Okay, actually we have to take a break, but thereafter I want to get a little specific in terms of whether banks will have troughed out their provisioning and start showing profitability in a couple of quarters thanks to this growth capital that is being available. And for the economy as a whole,
whether we are on the inflection point of better growth for two reasons. Because capital is available, liquidity is available, and the bad assets are now troughing out. Those questions. Welcome back to Indianomics. The government today announced a giant recapitalization against expectations that it will put in the balance 43,000 crores by way of recapitalization bonds. It announced that it will put in 84,000 crores by way of recapitalization bonds. That is an additional 41,000 crore, and largely to benefit at least 3 or 4 banks that are in the prompt corrective action straitjacket, and a couple of others who may get there, like PNB, and banks like BOB, who are on the threshold of amalgamation. We have been speaking with Anil Gupta of ICRA, former Executive Director of Bank of Baroda, R.K. Bakshi, B.G. Garan, the Chief Executive of Indian Banks Association, Jindal Haria, Associate Director, India Ratings, and Sameer Narang, Chief Economist at Bank of Baroda. Anil, what is your bank-wise analysis? Are you going to see a substantial number of them posting profits next year? In which quarter do you see a bulk of the banks trough out in terms of provisioning?
So I think in the current financial year, because banks may do aggressive provisioning when they get the capital also to reduce their net NPAs below 6%. So current year will be like a washout year for most of the banks, and apparently, like in a best case scenario, we'll have at best 3 banks, which can be SBI, Bank of Baroda, and Vijaya Bank, reporting our profits. But from the next year onwards, definitely we should expect a turnaround, and we should see more number of banks. I can't put up a number, but definitely with provisioning reaching higher levels, we expect them to reach by around 60% by the current financial year end itself. So definitely the provisioning head will be lower from the next year onwards, and we should see more banks reporting profit. So definitely non-PCA banks will definitely report profit from that.
This year, what loan growth are you penciling in, Anil?
So as of now, we were factoring in around 9 to 10%, but now with the recapitalization in place, we have to work out the numbers, and we should see positively better number from the banking credit, better than 9 to 10%.
Okay, just a quick question to you, Jindal. Chances are the government is going to tell the Reserve Bank or the Board of Financial Supervision that, the banks are meeting capital because we are giving it to them. The other filter is net NPAs, which will fall for several banks like Bank of India, come the next quarter. The ROA will still be a problem. There will be negative ROA. Is it legitimate to tell the Reserve Bank, just remove that filter for the moment because they are fulfilling others? Would that be a fair argument?
See, the PCA framework was designed to enable banks to actually relook at their lending processes, because some of their lending in the past could have led to substantial losses, and as a result, the financial year losses over last 3 years is what we are seeing. Now, the PCA framework forces the banks to probably relook at their lending processes, relook at their approval matrix, and all of these things. Removal of these conditions may not necessarily enable further lending. At the same time, we are trying to address the supply side of the credit.
Yes.
On the other side,
I agree to all that. All I'm saying is, can the ROA condition be removed without harming, say, a rating agency's view of the bank? I mean, imagine, you just look at the way an S&P or a Moody's also looks at it, besides your company itself. If the ROA filter is removed, will that give you a negative view of the sector at all?
That may not necessarily change the view of the sector.
Okay.
However, when the ROA is removed, it means that the internal accruals of the company are not factored in when you are asking the bank to lend further, which we think that is an important consideration.
Fair point. Okay, that's an argument to keep the ROA filter, but my sense is the way things are, that may be called off. Let me come to the bankers now. Mr. Kannan, what do you think will be the mindset of the bankers itself? Will they be more willing to lend, do you think, less competition from NBFCs and more capital and liquidity in the system? Do you think they will go out and lend? And more importantly, this last mile lending which NBFCs were doing, where they were more capable of, do you think the banks will be able to perfectly replace this absence of NBFC lending?
Last 1.5 years, I think the bankers have been actually clamoring, saying that we don't have capital, and therefore we are not in a position to start aggressively lending. And yes, you're right that many of the NBFCs took up the place of the bankers in lending to the last mile. But today, I think banks are generally geared towards lending to the small scale and the retail. In fact, I would say in the retail space, they are probably still way ahead of the NBFCs. But yes, in the SME space, they may have lost ground. But with this capital infusion and the possibility that they may not have too many provisions to make in the coming months, because most of the NPAs have already been identified, provisions have already been made. I'm not ruling out some aging additional provisions, but the large chunk of the provisions have already been made. So that being the scenario, I think this additional capital infusion would encourage them to go for more lending and reduce even some of the GSEC so that they are in a position to get some additional
inflection
margins
point, you would
and
say?
improve the profitability.
An inflection
Overall,
point,
I think
you would
it's
say?
positive.
An inflection point for the banking system in terms of loan
To a
growth?
large extent, yes, but we need to see, as I told you, the treasury yields have also come off. That's a double benefit they're getting, that they will not have to provide for the treasury loss of which they were all apprehending. And I think overall the scenario should be positive. Possibly an inflection point where the lending to the small scale and the retail will take off in a big way.
Actually, we are pinning a lot of hopes on product, Mr. Bakshi, that your former employer has, Bank of Baroda, this 59-minute loan software. Actually, Bank of Baroda has also done a lot in terms of using analytics to be able to identify and pass SME loans without taking too much time. Do you think this automation and analytics and machine learning that they have put in, plus the general positivity in terms of higher capital and lower provisioning to make, do all this give you the feeling that banking sector is in an inflection point?
Inflection point, I really don't know, because I will not put it that way. Vis-a-vis the analytics and the software-based lending, it's a long-term positive. I don't think it will show any big boost to credit in the short term, maybe 3 months or even a year.
For SMEs?
But that's a long-term positive, because the concern of the rating agencies and everybody who is interested in the sector, that the quality of decision-making should improve. It will be definitely facilitated from the bank side, and from the borrower they will be getting quicker approval. With the GST, income tax, negative list, defaulter, everything being scrutinized in the beginning, I think the quality of decision making will improve. False data will not be banked upon for borrowers will not be able to peddle false data. That's one good thing. But capital coming in and the
plenty of liquidity,
vacating some space, bankers hungry for lending. Sorry?
No, plenty of liquidity.
Plenty of, so liquidity and capital both being taken care of, that should be fine. And I think ROA condition should be removed. If that question is not to me, but I think that can be removed, because ROA is what? It is only dependent on the bank making net profit. There are many banks which for the financial year 18-19 will not make net profit. But the portents will be there that the last quarter or the provision trends in December and March will show that next year they will definitely be in profit. So a prospective view can be taken on that.
Okay. Very quickly, Samir, would you say that we are in for a good quarter of growth in the fourth quarter and in the next 6 months with this? Or do you think this is not good enough? We are still going to feel the pinch of the absence of NBFCs.
No, definitely we will feel the pinch, because when this money is actually available and deployed subsequently, it takes some time as well. However, having said that, the recent decline in oil prices will also be a big boost to consumer demand as well as manufacturing margins. So what you saw in Q2, which was below consensus, you'll definitely see an uptick in Q4 at least. So you'll see things improving, definitely.
Okay. Gentlemen, I'm actually borrowing time from the next show. So if you all can give me exactly one monosyllabic answer. I want to know what is the loan growth that you all are expecting in the next 1 year. Let me start with you, Samir. One number.
I think it will be 20%.
Okay. Mr. Kannan?
17%.
Okay. Thank God you didn't say 17.25. Mr. Bakshi?
It may be around 17-18%, which is a fair number.
Absolutely.
Too high number is also not something which led us into difficulties.
Yes, we have regretted in the past. Anil?
16% at best, because we'll have a higher base of FY19.
Of course. And Jindal?
We are expecting the growth at somewhere around 13 to 14%
Okay.
at a system bank system credit level.
All right, that's a conservative number. But generally, most of you are in between 15 and 20%, which is much better than the kind of loan growth we have seen in the last 4 years. Mr. Bakshi, Mr. Kannan, Jindal, Anil and Sameer, thank you very much for joining me.